Hello, and welcome to the ninth episode of Capital Markets Live. I am Alvin Lam, Managing Director for International Markets at Ginnie Mae. And today I'm joined by Nick Masuanis, Head of Agency MBS Research at JP Morgan. Nick received his finance degree from Princeton University and has been with JP Morgan for more than 13 years. Welcome, Nick.
Hey, Alvin. Thanks for inviting me on. Glad to be here.
Let's start with a big picture, the direction of the Federal Reserve. They are due to meet in early November. What are your expectations around changes to their pace of mortgage purchases?
Yeah, our house view is that the Fed is going to announce their taper at the upcoming November meeting, set up a program that decreases their net purchases by 5 billion MBS per month, every month, not per meeting. And that's been pretty well telegraphed at this point. We don't think that the announcement is going to be a shock to the market, and it would actually be kind of surprising if they didn't announce a taper at the next meeting, given how much communication there's been around it. Now, they conduct their purchases on a mid-month to mid-month cycle, so the most natural time for their first reduction would be in mid-November, though they did kind of hint that it could be mid-December. And that puts them on pace to wrap up net buying in early June 2022.
Yes, the Fed certainly does not want to surprise the market. So what about the compositions of their purchases? Should that change?
We don't think that the Fed's going to deviate from their current pattern. They currently buy in rough proportion to the issuance mix across deliverable MBS products. So they'll probably just scale back the total. I think, in fact, if they were to make any large adjustments to their buying pattern, it might be more disruptive than necessary. So that's why we think they'll just stay the course.
Yes. What does this mean for mortgage valuations?
So mortgages traded at option adjusted spreads roughly 20 basis points wider from here the last time the Fed tapered, but was still reinvesting their paydowns. That was at the end of QE3. However, the market is behaving as though spreads are going to remain compressed beyond the middle of next year when the Fed is done with this likely path of tapering. And one way to think about this is that rolls are pretty special right now. And so investors potentially could withstand some additional spread widening and then earn it back via the roll market. But the amount of extra carry they're picking up from today's special rolls is not enough to cushion a 20 basis point widening over 8 months of the Fed's taper. And so arguably you need something else to kind of be supporting spreads beyond just the Fed. And the massive amount of cash on banks' balance sheets could potentially provide that shock absorber as the Fed steps away. Banks are unable to generate a lot of loan growth right now. And so at wider spreads, they're an obvious marginal buyer of MBS. So in the near term, we think that this tight level probably makes sense. But over the medium term, we get a little bit more worried that we're at these historically tight spread levels and the supply demand picture starts to change a bit.
Thank you for sharing your views. Let's turn to the Ginnie Mae market specifically. Borrowers who took forbearance earlier in the COVID crisis have hit or are about to hit the end of forbearance. How will that play out in the coming months?
Sure, it's not a simple answer. The schedule of forbearance exits is very staggered. Borrowers get different amounts of forbearance depending on when they first took it. So if you took it right at the beginning of the crisis, you probably get 18 months. If you took it more recently, something more like 12 months. And that being said, forbearance requests really surged in April and May of 2020. And so those borrowers who got 18 months are running out of forbearance right about now, or either in September or October of this year. And so by looking at loans in the MBS data, we can see that of those borrowers who have not been bought out of securities, over half of forbearance plans were scheduled to expire before the end of 2021.
Yes, let's dig in a little bit more. And how do servicers try to help borrowers get back on their feet and stay in their homes?
Yeah, from our conversations with them, we understand that they start calling borrowers well ahead of the official end date of forbearance. They want to get some of that educational material out to the borrowers so they can make a rational decision about what's going to best benefit them once they run out of this no payment period. The FHA gives servicers 120 days after forbearance to get the borrower into a partial claim or into a loan mod. And while those procedures should take less than 2 months to complete, there are a lot of borrowers to process all at once. You're just getting this wave over the next few months. So I think that's why servicers want to reach out ahead of time and get guys going so that they can get these workouts in place. And borrowers who have needed 18 months of forbearance are probably going to need more education about their options than borrowers who just went delinquent for, maybe 3 months at the beginning of the crisis and were able to get a partial claim and get back on their feet. And I think servicers also have some flexibility to give borrowers a break on their credit reporting while they're in the modification process. So, as part of forbearance, borrowers were flagged as delinquent for MBS purposes, but not delinquent in their credit reports. So you can get a little bit longer buffer window for these borrowers who are in the process of getting a mod. So even if they officially miss a payment after forbearance ends, but before they finalize that mod, we think servicers are going to try to minimize the credit impact to the borrower.
We do want to help the borrowers. But what does this mean for the MBS investor?
Yeah, there are a few ways that this is going to impact Ginnie securities. The first and most direct way is that we're likely to see continued buyouts as servicers work through the remaining 60 billion or so of seriously delinquent loans that are still in securities. And borrowers who get partial claims can still stay in those pools, but mods are going to have to come out. And we think that the bulk of Ginnie borrowers who are hitting 18 months of forbearance are probably going to need mods at this point. I think if, you cured earlier, it's much more likely that you could get your regular income back and just get a partial claim. And in the latest MBS factor data, barely saw any Ginnie borrowers who were hitting 18 months of forbearance suddenly roll to current. And that stood in contrast to GSE space, where we saw over a quarter of those similar borrowers who were hitting 18 months of forbearance make the leap to current, indicating they probably stuck all of their missed payments into a second lien or a payment deferral, as they say in GSE space. So the data is somewhat limited, but we think that Ginnie borrowers are going to need more mods, and that's going to mean more buyouts.
So what would these buyouts hit the securities?
Given the window around the end of forbearance, plus that staggered final schedule of the end dates of forbearance, depending on when borrowers took it initially, we think it's plausible that we'll just continue at the current pace for the next 4 to 6 months. It's tough to say precisely. There are a lot of unknowns in that. And so forecasting buyouts has been a challenge with the last year. It's going to remain challenging through the end of this COVID workout, but we suspect most of them are going to be cleaned up over the next half year.
Indeed, we need to watch these borrowers as they make progress. What about all the borrowers who were already bought out of Ginnie Mae securities?
Yeah, that's a great question. Once the loans leave Ginnie MBS, we kind of lose track of them. We can look at the issuance of RG pools and modified loans, and we can get a rough sense of how many of those guys have come back into the market. And for context, there's been around 180 billion of buyouts in the COVID era. And then through September, there's around 60 billion of issuance of RGs and mods combined. And so that means that as an upper bound estimate, there's something like 120 billion of loans sitting on servicers' balance sheets. And we're waiting for those to reperform and then get repooled. Now, as those borrowers hit the end of forbearance, servicers are going to want to repool them. Part of the early buyout takeout is reinserting those loans into securities, getting them off balance sheet. And that's going to hit the Ginnie market as new supply. And, for mods in particular, it's going to hit some of the production coupons, since mods are typically struck at something near the Freddie rate or slightly higher in the case of VA.
So what are the characteristics of these modified borrowers? How do they perform as MBS collateral?
Yeah, we only have a year or so of data on these guys, but the early indication is that they have much better FICOs than pre-COVID mods. And the nature of this economic shock was very different from previous periods of widespread borrower delinquency. And these defaults were a lot more levered to DTI rather than FICO. So this means that the post-COVID mods that we've seen so far have been redefaulting at much lower rates than the mods we were used to pre-COVID. And that may change as we get into the later stages of forbearance. Some of the mods that we've seen were from borrowers who did not go delinquent for their full 18-month maximum and cured earlier. But for now, it does look like there's a material credit performance difference between these post-COVID and the old pre-COVID mods. Now, there's one other thing that's different about these borrowers, and that's that they're much more refinanceable. They ramp up basically immediately after issuance, and you don't get that 210-day lockout that you see on most Ginnie loans. And in addition to that, compared to pre-COVID mods, these borrowers are a lot more reactive to rate incentives. So their S curves are just much steeper. And so investors should look carefully at mod share so that they have a better understanding of what they're buying over the next few months, as a lot of these loans come back to market and enter into the Ginnie 2 multi-issuers in particular.
Well, you share a lot of information today. Well, it looks like that is all the time we have for today. Nick, thank you for your time and sharing your realistic views. I really appreciate your insight on Ginnie Mae on MBS market.
Yeah, absolutely. I appreciate the opportunity to reach out to the Ginnie investors.
That was Nick Masoulis, head of agency MBS research at JP Morgan. If you enjoyed this podcast, be sure to subscribe to future episodes of Capital Markets Live on YouTube. If you have any comments or questions about today's episode or other topics, please send us an email at ocmglobalinvestorinquiries@hud.gov. Again, the email is ocmglobalinvestorinquiries@hud.gov. Again, thank you for listening, and until next time, stay healthy.